Mutual funds, advantages and disadvantages. Before putting money into a mutual fund, it is essential to have a thorough understanding of both the positive and negative aspects associated with such investments. Mutual funds are presently one of the most popular investment vehicles among most investors. One of the most common investments made in the United States is through mutual funds. Hello everyone and welcome to another video on our channel. Today's video, we're going to discuss mutual funds, advantages and disadvantages. So stay tuned to find out. Now let's start our video. There's a wide selection of funds to choose from, each focusing on a particular sector of the economy or category of assets. This type of investment offers several benefits, including sophisticated portfolio management, the reinvestment of dividends, and decrease in risk, convenience, and competitive pricing. The expenditure ratios and sales charges are both rather high, and there are also managerial abuses, tax inefficiencies, and poor trade execution to consider. This article provides a more in-depth analysis of the benefits and drawbacks of the aforementioned investing approach. Advantages of mutual funds. Several reasons explain why high-frequency investors choose to invest their money in mutual funds rather than other investments. Let's get down to the meat and potatoes of several of these issues. Advanced portfolio management. When you purchase a mutual fund, you must pay a management fee in addition to your expense ratio. This fee is put toward the cost of hiring a professional portfolio manager who will be responsible for buying and selling various investments such as stocks, bonds, and other financial investments. The cost of having expert assistance with the administration of an investment portfolio is not very high compared to the potential benefits. Dividend reinvestment. Your investment will be able to grow at a faster rate if you reinvest any dividends or other forms of interest income that the fund receives into purchasing additional shares of the mutual fund in which they are already invested. This will allow you to take advantage of any potential opportunities for faster expansion. Risk reduction, safety. Because most mutual funds invest in anywhere from 50 to 200 different assets, depending on their specialty, portfolio risk may be mitigated by using diversification, a strategy employed by most investment companies. A good number of stock index mutual funds hold individual stock investments totaling 1,000 or more. Convenience and fair pricing. It is not difficult to purchase mutual funds, and they are also not difficult to comprehend. They usually have modest minimum investments, and they can only be exchanged once a day at the net asset value when the market is closed. NAV. Because of this, price fluctuations throughout the day and the many different arbitrage possibilities that day traders take advantage of being removed. The great mutual fund selections for you will be determined, just as they are for any other kind of investment, by the particulars of your financial situation, including your time frame, budget, and profit goals. If you're liking this content so far, please consider subscribing and liking this video. Now let's continue. Disadvantages of mutual funds. However, there are also potential drawbacks associated with becoming a shareholder in a mutual fund. A closer look at some of those worries is provided in the following paragraphs. High expense ratios and sales charges. Mutual fund cost ratios and sales charges can spiral out of control if investors aren't vigilant about monitoring their spending. When investing in funds with expense ratios higher than 1.5%, regarded as on the higher expensive end of the spectrum, you should exercise extreme caution. Always use caution when dealing with sales and advertising charges of any kind. Several reputable fund firms available nowadays do not levy any sales costs. The total returns on an investment are lower due to the fees. Management abuses. Your manager may take advantage of their position, resulting in churn, turnover, and window dressing. To do this, it is necessary to engage in transactions that aren't necessary, replace things that are in surplus, and eliminate losers in the inventory before the end of the quarter. Tax inefficiency. When it comes to the distribution of capital gains, investors in mutual funds do not have a choice regardless of whether or not they approve of the practice. Investors often get distributions from the fund at some point during the year that are treated as an unavoidable tax event. This is because turnover, redemptions, gains, and losses in security holdings occur during the year. Poor trade execution. You will receive the same closing price NAV for your buy or sell transaction on the mutual fund if you place your mutual fund trade anytime before the cutoff time for same-day NAV. This applies whether you purchase or sell the mutual fund. Mutual funds offer a poor execution approach for investors hoping for speedier execution times. This might be due to investors having short investment horizons, engaging in day trading, or trading to time the market. Well, that's all for today's video. Tell us in the comment section how this video was. I really hope that you found this one interesting. We'll see you in the following video with some more notable facts and stories. And until then, stay tuned.